Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook. Well, it's Labor Day Monday, and that means the markets are closed. So we do not have any real-time data to be able to look at real-time trades today. So we're going to make it an educational topic. Today, our topic is going to be Delta, which is probably the most important Greeks that you can ever find inside an option pricing calculator. So we'll talk about the Greeks, define it, and then we're going to take it and go to a live chain inside the TradeHawk software and talk about how the delta reacts within that chain. And we'll look at call deltas, we'll look at put deltas, but to start with, let's define what delta is. So I'd like to go to the options playbook and look at the section that's called Meet the Greeks. It's under the Options Basic tab, and I'll just kind of point to that here inside the Options Playbook website. And we have all the different Greeks defined under this tab, but if I scroll down and I see the topic, what is delta? The textbook definition of delta, I think, is very boring, but I do, since we are talking about delta, I feel like I should actually define it as far as the textbook is concerned. Delta is the amount an options price is expected to move based off a $1 change in the underlying stock. So that means that if you own an option contract, and let's pretend that we own a call option, if I look at the delta, and that underlying stock goes up $1, and I see that the delta is 0.70, that means that that option contract should go up by 70 cents. The stock moves 1, my call option moves 70 cents. Now, it does not have any regard to direction. So delta is just a theoretical number that helps me understand or develop a realistic expectation as to how much my option should move relative to the stock. So if the stock goes down 1, that means that my 70 delta call option should go down by 70 cents. All right. So that's the textbook definition and how that all works. But I like to look at delta a different way. And I actually wrote this non-textbook definition inside the app options playbook. So I'm going to scroll down a little bit and I'm going to look at under the section that says a different way to think about delta. So delta in general has a lot to do with probabilities. Now, it's a mathematical formula, and this isn't 100% accurate to say that delta means probability, but it can be used in that way. And so you can think about a delta this way. Delta non-textbook is the probability that an option will wind up at least 1 cent in the money on expiration. Okay, so let's think about that for a little bit. The probability that an option contract will wind up at least 1 cent in the money on expiration. Okay, so if the stock is 50 and the strike is 50 on your call option, what should the delta be at that moment? Strike is 50, 50 strike call option. What would you assume the delta is? Well, the delta is going to be very close to 50. Why? Because if the underlying stock goes up 1, that's in the money. If the underlying stock goes down 1 at that moment, that's out of the money. So at that moment, you have a 50-50 chance of that underlying stock finishing in the money. Now, this is in theory. Like, once again, everything that we're talking about with the Greeks is always in theory. It's a textbook scenario. Now, if the stock goes from 50 and let's say it goes up to 52, now what's the probability? Well, I don't know exactly, but it's a little higher than it just was. So guess what? That delta is reactive to that. So if I bought that 50 strike call, the stock now goes to 52. In that instance, my delta will increase, which means from that point forward, my option will increase at that point forward. As long as the stock keeps going up, my option will increase at a more rapid pace as I get further and further in the money, because the probabilities of it finishing at least 1 cent in the money changes. So the probability with the stock at 52 on my 50 strike call option of it finishing 1 cent in the money is much higher than when the stock was at 50. So the delta will reflect that. And the opposite is also true. If the underlying stock goes down in that instance, well, then the delta is going to decrease. And on the way down, my option contract's going to move at a slower rate. Now, realize we're just focusing on stock price movement. There are other Greeks that we will introduce on holiday Mondays, if you will, that will address, well, what happens to time decay? What happens with volatility changes? What happens if interest rates change, which is happening a lot nowadays with all the risk of recession and everything that the Fed is doing. Okay, so the non-textbook definition says to me that probability of that underlying stock finishing at least 1 cent in the money. Now, remember, it's not the probability that you're going to make money. It's the probability that it will finish at least 1 cent in the money. So if I think of delta that way, it helps me look at an option contract, say, I think the stock is going to go to here, and it'll give you some idea of where that'll give you some idea of how your option should react relative to that stock price movement. All right, so let's make a real world example, and we're going to bring in the puts into this example and talk a little bit about everything we just mentioned on the call options, but let's go and look also at the put options. All right, so I'm going to switch here. I'm going to move over from the options playbook site, and we're going to head into the Trade Hawk option grid. And I have all the Greeks highlighted inside this option grid, but we're going to use a very simple underlying stock, a very popular underlying stock, the SPY. And mainly because there's so much volume in the SPY, the theoretical that's behind the deltas and the gammas and the theta, all the Greeks, are pretty accurate. A lot of volatility helps that scenario as far as option trading is concerned. So right now we have the SPY at 450. The market is open. We're rocking and rolling. It is Friday that we're taping this before this Monday, so we do got live markets. And if I look at the 450 strike call option, which is on this side of the option chain here on the option grid, and I stare at that delta says 52. So that means that if you think about what we said in probabilities, we have 1 day, or we have the 6th expiration, which is 5 days away. And the probability of that call option being a little bit in the money right now, right? We're about 37 cents in the money. The probability of it finishing in the money is somewhere close to around 53%. So guess what? If we introduce the puts, we'll call it 54. Okay, we're at 54 now that I look at the chain. Then what's the probability of the put finishing in the money on the same strike line? Well, if you do a little bit of math and you say, okay, we have a 54%, we have a 54 delta on the call option. Well, it's got to add to 100, right? So if you take 100 minus 54, the put delta should be 46, because one of them has to be 1 cent in the money, either the call or the put when we get to expiration. I guess in theory it could land right at 450, but you get the concept. So if we look over here at this put delta, we see that delta on that strike, and it's just moved a little bit, is 45. It would be around 44, but we got a live market. So you add the call and you add the put, they got to be somewhere close to 100% because of the scenario here that either the call or the put option has to be in the money on expiration. Okay, now the opposite is true on the put, on the direction that you want the underlying to go. So if the stock goes down 1, that's positive for the put. If it goes up 1, that's negative. And you'll notice that there is a little negative sign in front of the put option. And that's because of this dynamic. So put options are negative, call options are positive, but if you add them together and you ignore the negative sign, you'll end up with somewhere close to 100 just because of the concept that we're talking about, the non-textbook definition about probabilities. And so let's go a little bit deeper in the money, right? Let's go deeper in the money on the call side. And we look at the delta over here. It's 0.20. It says 20 on the chart. So this over here should be close to 80. And it's a negative 80.79 on the put option. So you see that it's holding out throughout all the different strike prices. Okay. So one last little thing. I don't want to get too long-winded here, but I also want to let you know that delta will change relative to expirations. We're starting with a 5-day option contract, and we're looking at the delta for that 5-day option contract. If it becomes a 4-day option contract, the probabilities are going to change on the in the money and out of the money option contract. And then when it becomes a 2-day option contract, that's going to be the case. And then when it comes a 1-day option contract or just 1 day to live, well, then it's definitely going to affect the probabilities. And how does it affect the probabilities? We're going to go back to just focusing on the call options. It affects the probability in that the deeper I get in the money on the call option, as expiration approaches, there's a higher probability that's going to finish at least 1 cent in the money. Would you not agree? I'm in the money. I have less time for it to get out of the money. Probabilities will change, and so will the delta. So let's focus on, in this instance, we got a 454 strike call, and we see that that delta is 0.21. Now, if I go and look at the, 1 day to expiration, but the chain's going to say 0 days because you got about a half a day left here of trading. And that delta will increase on that same strike line. So it's the 454. We're looking at a delta right here of 0.22 or 22. And we click on the 0 days. So over here, this is the expiration, and this is a September 6th, has 5 days. And then you'll see that delta on the out of the money option contract is actually going to decrease because there's a lower probability of the stock actually finishing 1 cent in the money. So let's do that to start. So we click on the 0 days expiration. We look at the 454, and we see that the probability of the 454 strike is very low. It'd be 0.02. So a very low probability at this point in time that the SPY is going to go up 4 points and finish at 454, according to the delta. All right. And now let's go back the other way and go back to the other chain and talk about an in-the-money option contract. And we'll do about the same amount in the money. So 454, that was 3 points. And let's go 3 points down on this chain. Okay. So 448. So 448 delta, we got a 0.73 is our delta on this option contract. So now, since we're going to go shorter term expiration, 1 day to live, what's going to happen to the probability of that, or what's going to happen to that delta, or i.e. the probability of that option being 1 cent in the money? Well, it's going to increase. So let's, once again, we're right now on the September 6th date. Let's look at September 1, and we click on that, and the 448 option contract with that expiration, 448. And we see now that delta is almost 100. It's trading at, well, for a second there, it spiked, but it's 0.95. So there's a 95% chance based off of the delta that that option contract would be in the money on expiration, at least 1 cent in the money. All right. So what did we learn today? We learned that delta gives you a realistic expectation of how your underlying stock should move relative to a 1 point movement in the actual stock. We also learned that that delta changes. Not only does it change as the underlying stock moves, but it also changes as the days to expiration change. So you have, it's a dynamic number. It's an exciting number, and all option traders should actually know about delta. Now, one little anecdote before I head out here. I used to work at the Chicago Board Option Exchange, and all the traders on the floor always reference delta whenever you would ask them a question. So I'd go up to my friend Linda and say, hey, Linda, do you want to go to lunch today? And Linda would be like, oh, 20 delta. I'm very slammed. There's no way I think I can leave the trading floor. Or, for example, you'd say the day is done. Hey, Linda, would you like to go across and hit happy hour over at the Cactus, which used to be right across the street from the Chicago Board Option Exchange? And Linda would be like, 80 delta on that. I think I can pull that off. I could really go over and enjoy happy hour. So every time you would ask a trader a question, a lot of times they would respond with X number of percentage on delta. So just a little fun anecdote from the trading floor. My name is Brian Overby. Thanks for coming to Options Guy TV. Please give us a thumbs up. We would appreciate it. And we'll see you Tuesday with live markets on the next Options Guy, or we'll see you Wednesday with live markets on the next Options Guy TV. Thanks for coming, everyone.